Hello and welcome to Financial Literacy, the channel that helps you understand the world of money. In this video, we're going to talk about how banks work. Banks are financial institutions that provide a range of services, such as savings accounts, checking accounts, loans, and credit cards. They are a vital part of our economy and play an essential role in managing our money. Let's start with the basics. When you deposit money into a bank, you're essentially lending the bank your money. In exchange, the bank pays you interest on your deposit. Banks use the money they receive from deposits to lend to other people and businesses. Banking is the process of providing financial services to individuals, businesses, and governments. Banks play a vital role in the economy by accepting deposits, providing loans, and facilitating transactions. Here are some of the basics of banking. 1. Types of banks. There are several types of banks, including commercial banks, investment banks, and central banks. Commercial banks provide banking services to individuals and businesses, while investment banks focus on underwriting securities and providing advisory services. Central banks are responsible for regulating the banking system and controlling the money supply. 2. Deposit accounts. Banks offer a variety of deposit accounts, including savings accounts, checking accounts, and certificates of deposit, CDs. Savings accounts typically offer low interest rates but are easily accessible, while CDs offer higher interest rates but require a minimum deposit and have penalties for early withdrawal. 3. Loans. Banks provide loans to individuals and businesses for various purposes, such as purchasing a home or starting a business. Loans can be secured, backed by collateral, or unsecured, not backed by collateral. The interest rates and terms of the loan depend on factors such as the borrower's credit history, income, and the amount of the loan. 4. Credit cards. Banks issue credit cards that allow individuals to make purchases on credit. Credit cards typically charge interest on the outstanding balance and may offer rewards or cash back. 5. Online banking. Many banks offer online banking services that allow customers to manage their accounts, pay bills, and transfer funds from anywhere with an internet connection. 6. Regulations. Banks are regulated by government agencies to ensure they operate safely and soundly. Regulations also protect customers by ensuring that banks are transparent and fair in their practices. Overall, banking is a crucial component of the economy, providing individuals and businesses with access to financial services and helping to facilitate economic growth. Banks make money by charging interest on loans and by charging fees for services, such as checking accounts and ATM usage. They also earn money by investing their own funds in various financial instruments. Banks are regulated by the government to ensure they operate in a safe and sound manner. The Federal Reserve is the central bank of the United States, and it regulates banks and manages the country's monetary policy. Monetary policy is the process by which the central bank of a country manages the money supply, interest rates, and credit conditions to achieve specific macroeconomic goals, such as price stability, full employment, and economic growth. The central bank in most countries is responsible for implementing monetary policy, and banking plays a crucial role in the process. Here are some of the ways in which banking and monetary policy are interconnected. Reserve requirements. The central bank can influence the amount of reserves that banks are required to hold. By changing the reserve requirement, the central bank can affect the amount of money banks have available for lending. Open market operations. The central bank can also influence the money supply by buying or selling government securities in the open market. When the central bank buys securities, it injects money into the economy, which can increase the money supply and lower interest rates. Conversely, when the central bank sells securities, it reduces the money supply and raises interest rates. Discount rate. The central bank can also influence the interest rates that banks charge each other for short-term loans by setting a discount rate. When the discount rate is low, banks are more likely to borrow from the central bank, which can increase the money supply and lower interest rates. Lending facilities. The central bank can also provide lending facilities to banks during times of financial stress. These facilities can help ensure that banks have enough liquidity to continue lending to their customers, even if they are facing short-term funding challenges. When you apply for a loan or credit card, the bank looks at your credit history to determine your creditworthiness. If you have a good credit history, you're more likely to be approved for a loan or credit card. Banks also play a crucial role in the economy by creating money. When a bank lends money, it creates new money that didn't exist before. This is known as the money multiplier effect. The multiplier effect is an economic concept that refers to the process by which an increase in bank reserves leads to a larger increase in the money supply and ultimately a larger increase in economic activity. In the banking system, the multiplier effect is often associated with the creation of new money through lending. Here's how it works. Banks are required to hold a fraction of their deposits as reserves, called the reserve ratio, to ensure they have enough cash on hand to meet withdrawal demands from their customers. When a bank receives a deposit, it can use some of the funds to make loans to other customers. For example, if a customer deposits $1,000 in a bank with a reserve ratio of 10%, the bank can keep $100 in reserves and lend out $900. The borrower then takes the $900 and deposits it into another bank. The second bank can keep $90 in reserves, 10% of $900, and lend out $810. This process continues as the $900 is deposited and lent out again and again, creating new deposits and new loans with each step. The result is that the initial $1,000 deposit can lead to the creation of several $1,000s in new deposits and loans throughout the banking system. This multiplication effect occurs because the money supply is not limited by the amount of physical currency in circulation, but rather by the amount of reserves banks hold. By lending out a portion of their deposits, banks are able to create new money, which in turn can be lent out again to create even more new money. The multiplier effect can have a significant impact on the economy. When banks are lending more, individuals and businesses have greater access to credit, which can spur spending, investment, and economic growth. Conversely, if banks are not lending as much, the economy may slow down. Overall, banks are an essential part of our financial system, and understanding how they work is crucial for managing your money. Thanks for watching this video on how banks work. If you found this video helpful, please like and subscribe to our channel for more financial literacy content.